Welcome to the Broken Pie Chart Podcast, episode 315. I'm your host, Derek Moore, and it's just an emergency episode, Jay. You're back. No, it's not an emergency episode.
I heard people wanted me to be here, so I am here to talk about the markets with you.
Yeah, well, this is pretty good timing because, I don't know if you've been paying attention, but there's a little bit of volatility in markets. I'm not sure if you knew that.
What?
This week
I wasn't paying attention. Of course. Yes. Thriving on volatility.
Yeah, we did one a couple weeks ago, but I said to you today, I messaged you today, I'm like, timing couldn't have been perfect because this is a perfect week to do it. So let's just get into it. Coming into today, we had reached a 7.1% decline in the S&P. And I know we rallied off the lows today to close positive. Actually, a pretty nice close. 100-point swing though, Jay, from the low.
Another day of 100-point swing, 100+ point swings. These are long bars, right? So what do I mean by that? Like if you're looking at a candle chart or an open, low, high, close chart, these are long, right? These bars are long, and typically that shows volatility and speculation. Speculation down, speculation up. But yeah, I just call them long bars, and we all just know what that means. A bunch of long bars together.
Yeah. I mean, to put this in perspective, so the back of the napkin way to do this, it's not the right way to do it, but the back of the napkin is to say the VIX at one point was between 20, it's really been between 20 and 25 this week. But at a 25 VIX, you divide it by the square root of 252. That's the number of trading days, 15.875. And what did I say? I just did the math before. It is about 1.5%.
1.5% move, but that's close to close. That's not high to low or low to high movement intraday, right? So the thing about that is, like today, for example, like you just said, 100-point swing, but we closed at up 0.5%. You could argue, today should have lowered volatility. And by the way, it did. It lowered the VIX. The VIX was down by 6%. But really, it was a pretty volatile day, having that, almost 2% swing intraday. I always like to say, if you can have that kind of a swing, it means it could continue going the other way. Meaning, like at one point today, I think we were down 70 basis points. We're down over 100 basis points, I think, at one point today. And so in that scenario, you could have kept going instead of the swing up. And so that's the thing about volatility. Volatility is kind of a blend of all these periods, and it's the average of what you should expect. But you could have intraday moves that exceed that, and then you could have kind of what I'll say, a move with the other move on top of it. And so I love the fact that we had a rebound today, after noon. Thank you, Powell, because that happened right as he was giving his little speech, and he talked a little bit about, hey, look, the job market is stable, and we have the ability to cut if we want to, but inflation is kind of keeping us pat. We didn't prepare this at all, Derek, but that was the thing that turned the market today. Powell, whether he did or didn't know that he turned the market, it happened right when he was speaking.
It's the Fed put, it's the Powell put, back in action.
Yeah, he's just got to say we could cut. The Fed could cut. And I think it was also saying, look, the jobs number is not very bad. I know we're going to talk about the jobs number in a little bit, but he said,
we got a ton of stuff to talk about today, for sure. Yeah. I mean, do you think, though, that was scheduled in advance, too. We talked about that on Monday, where we looked at we always look at the economic calendar. We look at the Fed calendar, and we're like, who's going to talk? That was scheduled. It wasn't like Powell was just off the cuff or came out because of the...
Right.
That was just a normal speaking event.
But he addressed kind of what's going on he addressed uncertainty with tariffs. He addressed the jobs data that came out. He addressed a little bit of inflation. So he kind of hit on all the winning points that you want from the Fed. It was nice that it was scheduled. I really didn't think that was the mover of the market. I thought it was going to be the jobs number this morning, which I thought was fine. We'll talk about that later too. But back to this kind of volatility that we're experiencing right now. This happens all the time, everybody. Like, I know that it's easy to to get used to not having it, right? It's been a little while. It's been really since August since we had any real volatility, August of 24. But this happens fairly regularly, right, Derek? This is something that goes on.
we put out an article on ziginvestments.com. You can go to that. I'll put the link in the show notes. And we made the case. I mean, one of the core things we do is we buy and we hedge, or we buffer. And it's like, this is why you hedge. But in there, I have a clip of Peter Lynch making a 1994 address. And at the time, he was talking about corrections. And corrections are a 10% decline in the market. That's kind of the...
Which is an arbitrary number. I know it's a nice round number, but
that's what he was referring to. Yeah, it could be 10, could be 8, could be whatever. It could be what you don't want. That could be a correction for you. Yeah. But he went on to say, he said, look, there have been 10% declines in the market in 93 years. And this was 1994. I mean, it's an old clip. And he went on to say, he's like, these happen all the time. That basically means they happen once every 2 years. And they're natural. And he, as a portfolio manager, I mean, for anyone who doesn't know what Peter Lynch was, he ran Fidelity's Magellan Fund. Like, he was a big deal back in the 80s and the 90s. He interestingly just kind of walked away from it. But he was talking about that. And I think it was a good reminder, like, this is natural. And we look here, we have some numbers. This is from Charlie Bolello. And 2024, July 16th to August 5th. Remember that? That was recession fears, Fed behind the curve, the yen carry trade, minus 9.7%. What do we have? In 24, March 28th to April 19th, minus 5.9. Stubborn inflation, Fed pushing back rate cuts, Iran, Israel conflict. Okay. And then, like, just go down the list, like, pick something. Oh, 2011. Oh, okay. That was a big one. I shouldn't have picked that one, but minus 21.6. Europe's debt crisis, double dip recession fears. Here we go, Jay. May 18th to May 15th of 2009. Worries that market has gotten ahead of itself. Well, that apparently was an unfounded fear.
What does that even mean? It's just the market just went down 5%.
I don't know. Like, look at these. Like, Ebola, global growth fears, falling oil. When was this? 2014. September 19th to October 15th, minus 9.8%. Like, this happens all the time.
Yeah. And this is, minus 7, which is kind of where we are on the chart now. Like, that's not even close to the middle of the road with some of these numbers, right?
No.
There's a bunch of 5s here, but, like 9, 10 seems pretty normal. Double digits start to get a little wonky. You don't want that as much, but still, this is like, it's especially after the run up that we've had. This is not terrible, right? This is, look, it's why we hedge, so we don't have to worry about it. But quite frankly, what we've seen so far, yeah, it's, people are calling us and people have questions like, hey, is this really going to be disruptive? And the answer is, looks like things are going to be a little disrupted for a while, but that's fine. Markets continue to go up. Market was at an all-time high. How recently?
February. Was it February 19th? Was that the day?
It was February 19th. It was an all-time high for today's March 7th. So it wasn't that long ago, right? It's okay.
What's happened though is, and I touched on this last week. I know you listened to it 37 times in your car. You listen to it every day going to and from the office this week. But I'll repeat it. The Mag 7 reached a high right around December 17th. They have not made a new high since then. So we've had a shift in the leadership in the market, and it was actually healthy for a bit, where you saw something like the RSP, the equal weight index, that made a new high. You have like the total stock market, that was doing fine. International all of a sudden started to come back. But the fact that the Mag 7 has gone down, I mean, the Mag 7 I think is down 20, are they close to 20% now? Maybe they were at one point.
I know it was over 15. I haven't looked.
Yeah. I don't know what it was today. But, that to me is something where those companies, the ones that were working, the ones that were driving the market, okay. And I think that's healthy. We went from a 23.3 forward PE on the overall market. Certainly the Mag 7 was more. Today we got down to about a 20.8. So, I think it's kind of healthy. And again, to repeat what you said, this is why we hedge. Like, if you hedge, Jay, here's an off the cuff question though. Like, I started to hear naturally, people start to see things in the news. Their friends are talking about it. They watch the portfolio go down, and there's some fear like, oh, should I get out or should I change? Should I do something else? I think that's almost a little bit of a positive contrarian sort of signal, wouldn't you say?
Well, I think the emotional reaction without any data is definitely, you always want to be on the other side of it, right? So if emotionally people are going, I think this is going to be bad, I want to get out, without any real data behind it, with just stories and not a plan, then yeah, I think that is a little bit of a contrarian indicator. If something changed, which I think you could make the argument some things have changed, and then you could quantify that, then fine. Then maybe you want to make a measured or a calculated move. But I do think when the what do you call it, the cupcake indicator, when that starts kicking in, it's a nice contrarian indicator, right? When the masses are just feeling it on emotion, right? If you got to take emotion out of it.
Yeah. For anyone who doesn't know what Jay is referring to, I sort of coined the term the cupcake indicator, because when you pick whatever city you want, whatever town you want, and you watch the local news, and on their morning show, they've got somebody like baking something in the studio, and in the corner of the screen, it's always the Dow. They have like the picture of the camera of the Dow, up or down, and you see the Dow's down like 500 or 1,000. When you see that, that's a great contrarian indicator that it might be time to buy, because when it hits the news like that, it's like, and they always show the Dow. I remember going on one time and I'm like, why do you guys show the Dow? Because they were going to show it, as I was talking, and cut to it. And the guy's like, that's the feed we get. I don't know.
That's not the one anybody uses. I saw something else, and I'm sorry I didn't give you the source on this. So I think I can't remember where I saw it, but it was like whenever CNBC runs the Market in Turmoil special, like 45 out of 45 times, it's up less than a year later. Like it's like 6 months later, the market is positive every time. Which seems weird to me, because I would imagine they ran the Market in Turmoil at the beginning of, the .com bomb or the Great Recession. But anyway, so like I just look, we are definitely influenced by the media here. The media benefits from selling fear, right? More eyeballs. You're going to, when the market's doing just great, if you're not into the market every day, you're not logging into CNBC or logging in. You're not putting on CNBC. But when things are a little scary, you're watching more often. So like it's a little bit of bias, right? That kind of causes it. But the people communicating to us are also incented to get you emotionally reactive, but whatever. That's where we live.
I tell you what's not good, and this is kind of what happened in late 2008, like that fourth quarter of 2008. It was sort of apathy, mid 2008, and it was the whole, I'm not even going to look at my statement anymore. I'm not.
Oh, it did go. It went all the way to the other end, right? Because the market top to bottom was down 60%. Right. I mean, it still continued.
At some point, people, wasn't even contrarian, and it's just like, I don't even care anymore.
I just can't even open up my statement. I remember like a jobs report, minus 600,000 jobs. Right. It was like, ooh, that's a rough one. Like we haven't seen that. I mean, I guess we did see it in 2020, but we saw millions of jobs.
Yeah, in a normal period, though. Yeah.
Yeah. Normal period, you don't see it. Derek, just a quick question about the Mag 7. You brought it up.
Yeah.
So the Mag 7 kind of led us through and kept the market, the S&P, higher through like 2023, right? You remember that you take out the Mag 7, the market would have been down. Remember, everybody predicted recession. They weren't really wrong about the market but the Mag 7 pulled everything higher. Do we think it is a leading indicator for us that Mag 7 is lagging, or it's when the market does recover, those recover first, or those recover stronger? I asked this because at least twice this week when the S&P was down, the NASDAQ was not down as much, and that is unusual, right? Mm-hmm. So I'm wondering, do we end up seeing like watching the Mag 7 being the, what to watch to lead out of this, or it's just going to continue to lag? What do you think? Is it a leading indicator that it's down and the market's going to follow, or if you're going to play the rebound, you play that first?
I think we need to see earnings. I think that's where it comes in, because these earnings have been good for the Mag 7. I mean, Tesla, I mean, they were still good. I mean, Tesla's down like 35%,
35,
40%.
yeah, for the year, yeah.
But don't you think we have to get to earnings?
Well, I'm thinking market dynamics. So earnings will definitely provide some clarity here, and I know we're going to talk in a minute about earnings. But I'm just trying to see, like, do I use the Mag 7 performance as, okay, here comes the rest of the market will follow, or it's just lagging behind and the market's probably going to go down, continue to rotate away from the Mag 7? That's the question I'm trying to look at. I mean, how many times did you and I look at the market and wait for Apple to start the rebound first, right? I mean, I could think of many times where, heck, 2018, 2020, right? We would watch what's Apple doing, and that was kind of the indicator that, okay, the bottom fishers, the bottom buyers are coming in because they went to Apple first because it would lead out. I'm watching Nvidia now for that, and it's just not happening.
No, it's not. And that's a little bit of a growth thing. But I mean, Nvidia's earnings, we haven't been on the air since Nvidia came out. I mean, it's like, could you ask for a better earnings report? Oh, 75% year over year. Like 75%, is that bad? Is that not good enough? Pretty good.
It was not good enough.
Good. No, to get to your question though, and I've been watching this for a while, I felt like the rest of the market was broadening out. Like that. So the RSP is an equal weight ETF that I like to watch. It was broadening. Like you had other companies start to do well and pick up the slack. Remember, the Mag 7, its last all-time high was, I think, December 17th. We already said it. February 19th, I think it was the 19th, there was an all-time high in the S&P. That means the Mag 7 did not drive that. I think that was already happening. So to your point, like, okay, maybe some other leadership has to hold the buckets for a bit. But I don't disagree. I think companies like Nvidia, like at some point, their price falls enough that their forward PE starts to look, oh, actually, it's getting cheaper.
Juicy.
So, I mean, look, we don't know what's going to happen. The other thing I'll ask you too is, you and I have always said, and by the way, Apple's only down it's like 5.5% since December 17th versus the Mag 7, looking at something like MAGS, which is a Mag 7 ETF. I assume that's a good proxy, down about 15.5. High yield is down, like 0.75%. And the reason why I bring up high yield is what we have not seen yet is we have not seen spreads widen. It's actually like something like SJNK is down minus 0.43%. If this was a credit issue in the economy, like if it was a real bad thing, you would expect that to be down as much. It's not. That's different.
Yeah, and that's real, like, recession default fear.
Yes.
Finding itself in there. And so I'm with you. Although, look, S-Junk's right at its 200-day moving average. It's still a pretty darn tight chart when you look at that.
Mm-hmm.
I mean,
all right, I want to get into so I think I'm undecided on the leadership going forward. But I don't disagree. Like there could
I was
be
curious about Berkshire too, right? Like that's, you think about reflection of really a broader market sell-off. You could look at that. Now you brought up Apple, so I immediately went to Berk. Berk is looking pretty good, right? You look at Berk B, its all-time high was this week. I think it was Monday. Yeah, and it dropped, to 495 from 518, right?
It's up 8.77% since December 17th. Same time, yes. The Mag 7's down 15.5.
Yeah, so it's like, is there a rotation of quality? You could argue that's a representative of that. Again, broadening out so it's just food for thought here. I'm just trying to figure out if I was going to play a rebound, is it the Mag 7 or is it taking its lumps already, or will it continue to lead and pull the rest of the market down? Don't know.
Yeah. Well, back in May of, I guess we got to move on from this because we had a ton of stuff. But March of 20.
Sorry, I got us sidetracked.
No, that's all right.
Well,
remember, like March of 20, we were kind of like, oh, if you believe in the turnaround here at the bottom, what do you buy? Well, you buy like triple C bonds, junk bonds, like the junkiest of the junk, and you buy like small caps. If you really believe it's the bottom, like that stuff will rip. I mean, I wouldn't necessarily buy bonds here because they haven't really gone down. I mean, I don't necessarily, I don't now want to buy bonds.
You want to buy small caps. I mean,
I don't know if I want to buy small caps.
No,
though.
I'm just saying that you do. I'm just saying what's the pullback on that, right? The Russell 2000 closed at 2075. Its high was 2466. That's a 16% drawdown. It's approaching bear market territory.
Yeah. No, you're not wrong.
Not what happened after the last election for sure. The last time Trump won the election. It's not what happened. This is the opposite.
Somebody, I think I mentioned to you, I went to the CFA Society dinner in Phoenix, and the moderator had made the point that this goes back to Nvidia. The fact that chips have not made a new high, or chips are actually flat or down since whatever period she was referencing, but yet the CapEx spending is all up. The chips is an interesting area for me. Like, at some point, does that catch up again? Because they've gone nowhere. They really haven't. Nvidia, 75% year-over-year growth. Like, okay. Did you want 80? I don't know.
Broadcom had a day today, right?
Yeah, they were up.
AVGO, right? Up 8.5% today. Good earnings. It was higher overnight yesterday after earnings, right? Finished today at 194. Touched 214 yesterday after the release, up off 180. So look, still a good day, but it could have been better. Better. Yeah.
To me, this is multiple contraction, which brings us to, we'll get back on track. We touched about 20.87 forward PE. 2 weeks ago, week and a half ago, whatever it was, it feels like forever. We were like 23.3. We did a webcast for advisors, and I remember the slide I had was 23.3. So the multiple contraction, earnings have gone up. Earnings estimates for the next, the blended forward 12-month estimate, it's like 271 a share right now in the S&P. So earnings estimates are good. The multiples come down. Like, this is, you and I said it, like, all right, do you go to 25 multiple? Like, when you're at 23.3, it's where do you go? And so multiple contractions or a change, like a 1 point difference in the multiple, it's pretty significant. And I guess the question is, do the analysts start to bring their earnings estimates on the S&P down due to the tariff stuff? Because right now you'd argue, earnings are still strong. It was just a multiple contraction. But the multiple contract ahead of expected reductions in earnings? I guess that's the question.
Is that a question to me?
Yeah, why not?
Yeah, I don't know. But look, when you talk about...
you're the only one here, so who else am I going to talk to?
I don't know.
Right?
Sometimes you talk to yourself. I think multiple contraction is, for everybody, is a fancy way of saying, hey, while earnings are not getting hit, the market is still going down. That happens to be the scenario right now. It could be earnings down and market goes down even more, but it just means the market is not... the market price, the price of the stock market, is not keeping up or not reflecting, what earnings are reflecting as much optimism as earnings were causing before. So this whole thing about contraction of the multiple tells us, hey, because earnings have been fine, as you've pointed out, right? We haven't had a problem with earnings. Just people aren't as willing to pay up for earnings like they were before. Because I remember... what was it, 2021, the end of 2021, right? We saw a decent multiple contraction after that as we went into 2022, right? So like there are times, like you said, that, look, it can be a range bound indicator. It doesn't mean you can't stay high for a while, but this pullback that you've seen in the multiple is interesting, Derek, and you do a good job of always reminding us of where those levels are. Now, I don't think fundamental investors are as quick to move based on multiple, right? They're doing a little more, they're a little slower to make investment decisions. So I think that is less of a case than, say, a technical trader who's going to buy as you hit the 200-day moving average, or buy or sell as you hit certain support levels. But I do think that it's important to watch this. And I think you've been really good about pointing out, like, there's an uptrend in multiple. We just happen to be at the bottom side of the channel.
I'm just looking here at price on Nvidia. I did it live, Jay. So I'm looking. The forward PE ratio was 42.73, June 18th of 24. Today, we are 24.125.
So that's a significant contraction in multiple because their earnings have been fine, like you just pointed out. Did you want 80% growth? So now you're just getting 24% versus 42 before.
Yeah. It takes me a second to do this live because on Bloomberg, you have to configure something for it to sort of, so that's why I've been glad you've been talking a little bit. Give me 1 second. I'll tell you have their earnings expectations gone up? And the answer is, yeah, this is the highest earnings expectation. It's basically like 150. What is that? I got to get my $4.67 a share. You can't see my chart, Jay, but that is up from, the forward when it was really high was only like $3.18. So here's a situation where you explained before. Earnings estimates are going up. The price is coming down. The forward PE ratio. But it's not because earnings are coming down. It's because investors are willing to pay less for future growth. And I think this is an interesting way to think about Nvidia. I mean, maybe they don't believe the estimates. I don't know. Or there's more just sellers than buyers. And I know you love that, Jay.
It's my favorite thing to understand why things are moving that you say. I mean, it's if we say in the options market, the implied volatility is the way to gather the emotional impact within pricing. When you look at PE ratios, to me, for a fundamental perspective, that's the emotional impact. And the fact that people were going to pay up 42 times before, and now they're only paying 24 times despite earnings going up, tells you that there's this, speculative nature that the market doesn't believe that earnings will continue to go up.
If you went to a 40 PE right now, the stock would be $186, $187.
Yeah,
closed at
right.
112.69 today. Like, imagine that.
If you just went back to and that's if earnings didn't change. It's just the ratio, the P, P ratio changed.
All right, I want to get to this too. You in your book, Buy and Hedge, crossed out the buy and hold. You have the hedge. Good book. Get it on Amazon. You made the point that the greatest up days cluster around the greatest down days.
It's
Fund
true.
Strat.
Yeah.
What's that?
It is true, right? The biggest up days are right around the biggest down days.
So Fundstrat put out this chart, S&P 500 annual return versus, this is Tom Lee's company, right? Yeah, it's Tom Lee. So
yeah,
S&P annual return versus annual return X the 10 best days. So we took the 10 best days out the past 15 years. And the average is 12% average annual return. Take out the best 10 days, it goes all the way down to a minus 10% average return. I bring this up again, Jay, because one of the challenges for investors who have a plan, who've agreed that equities are part of that plan, we would probably say hedge or buffered in there too. But it's the idea of, maybe I'll try and time the market, and because I think it's going to go down more. But Jay, a lot of times, like, it's just hard because you don't know when the best days versus the worst days are going to be. And like you said in your book, if you look at a chart of the worst days in the market versus the best days, they're all around each other because you get those snapbacks, right?
Yep. Yeah, you get whipsawed. We talk about that. That's a term that we use where the market's going down and then snaps back the other way. Yeah, I mean, if you were a seller on the worst day and go, ooh, God, I'm out, and then the next day was the big rebound, you did yourself no favors being out, right? Because you don't want to miss those big up days. I'm going to tell you something, Derek. This has been this data point is exacerbated from when I wrote the book in 2010. Now we're at 2024. But being down, you missed the 10 best days. Your average return is minus 10% versus being up 12%. That's a 22% swing. Wow.
Amazing.
Wow. Don't miss the up days, guys.
Yeah,
I don't know any other way to say don't miss the update. By the way, by the time you realize it's going to be the update, the market's already gapped up and you're chasing it in the morning, right?
No, that's right.
You got to be in it already. So why not just hedge and manage your risk that way so you're not taking the best days off the table?
Yeah, and that's the whole point. It's just, this way you can stay in the market. I made the point in the article too, for people who are pre-retirement, have considerable wealth in retirement, especially newly retired, but they still need growth. I think it makes sense because you want to take
that's
out
when you have the greatest investing risk.
the first part of retirement.
Yeah,
because if you get a drawdown,
it's not when you're 85 and you're in retirement. At that point, you made it or you didn't make it, right?
Yeah.
It's at 65 when you retire and the income is significantly decreased. It's your riskiest time for investing. That's when you'd want to take the most risk off the table. That's not conventional thinking, but it should be. Right? Mm-hmm. Conventional thinking is, what was the old formula? Oh, you take your age, and that should be the percentage of bonds, treasuries or bonds that you own. So, that's going the wrong way, right? So your risk tolerance really should be at its lowest on approach and in the first part of retirement. That's when you should be managing your risk the most. After that, you could start to add risk because now you're either, you should be taking on the risk of your heirs who you're going to leave the money to, or why not be a little more aggressive if your math is going to work out for you that you're fine and you're not going to run out of money, right? So we have that conversation fairly regularly. I would say, to a 30-year-old who probably doesn't have that much invested, they should just be aggressive. Hedging is less valuable or less meaningful to you. And, when you're I'm not saying 80-year-old people should go out and buy, MicroStrategy. But what I'm saying is you can add risk then because you're going to make it already. Still measure it, but, you don't have to be all bonds when you're 80 years old.
For young people, and I want to couch this a little bit, but your return doesn't matter that much.
It really doesn't. Just keep putting money in.
Yeah. You'll grow your wealth by contributions much more than the gain from a portfolio.
Absolutely.
If you have $10,000 and you're young, if you make 10%, that's $1,000. But if you put in an extra 10,000 because you're like, oh, I'm going to start putting more money away, you just grew your wealth by 100%.
That compounds you have so much time. Yeah. The math is almost silly. Why don't we teach that in schools, Derek? Can we teach that to somebody?
I'll tell you this quick story. I taught I don't want to say on the side because it demeans or belittle. It doesn't put the right respect on the effort I put into it.
In addition to your work at Zega, yes, managing
so
money.
I teach graduate economics and finance, but I have taught undergrad. And a number of years ago, I taught, it was 10 person, Econ 101 class. And I took a whole class, just an hour. And all I did was show them the compounding, show them everything. And I look, and there's some people looking at their phone. But I didn't care because if I got to 5 people, that's what I wanted. And literally a number of years after that class, people from that class emailed me and were like, oh, I took your advice and I have X amount of dollars now. And I'm like, are you kidding me? That's amazing. Somebody's in their mid-20s. So I agree. I think the argument is they're not ready to hear it but look, you get a couple people. It's like, what's the movie with Owen Wilson where he does the, where he's got the father-in-law and he goes and talks to the class. He's like, maybe 3 people will get it. I don't remember what that was. It's got Lance Armstrong does Armstrong does a cameo.
All right. Well, this is easy enough to find.
Well, I know. Owen Wilson. Was it Matt? It's going to kill me now. Yeah, we got to do this now because we're not going to come back to it. Let's see. It was probably 2010.
You, me, and Dupree, it says.
That's it. He goes and gives the talk. He goes, you guys are the pods. You guys are the future. He goes, some of you will get this. Some of you were meant to hear this message. For those of you, I got you. For the rest of you, you'll be ready at some point.
At some point, you'll be ready. All right.
I'm ready to talk about VIX, though, so implied volatility versus historical volatility. We already talked about how the VIX got to 25. The VIX did not spike like we saw it in December. Certainly didn't spike like we saw it in August. But, Jay, let's talk about historical versus implied volatility. Historical is what the market actually did, the changes from day to day and the volatility there. Implied is what the options market is expecting going forward. Jay, I know you and I watch this all the time. This gap is opening. Like for a while, the market was more volatile than really was implied, but this is open. Let's talk about this for a minute or two.
Okay, so what you're talking about is comparing what the options market is projecting, how much the day-to-day movement that's going to happen. In other words, volatility. The options market predicts that, right? And the way it predicts that is the pricing of the options out, 1 week, 2 weeks, 3 weeks, 4 weeks, right? So they use the pricing of the options to imply, hence the word imply where the market, how volatile the market can be. So if someone's willing to pay up for a protective put or pay up for a speculative call, that will increase the price of the options. And that implies, because of the way it traded, how much the market can move, right? So the option prices implies where it will go. I'm saying implies a lot of times on purpose. That's implied volatility. Historical volatility is actually what happened. You can't change that. You can't trade it. It's already behind you. It's the left side of the chart. It has already happened. It's actually how much the market moved over the last, let's say, 30 days. Did you pick a 30-day historical volatility on the data? Yeah.
Yes.
So how much has it actually moved? Like you do the math, like you go back to your statistics classes, you have 30 data points and you do the math and you say, you sum it up, you divide it by the square root, and you say, okay, sorry, I breezed over the equation, nobody cares. But that's what has happened. And so one of the interesting things about the market is, you and I have done a study on this, somewhere between 70 to 75% of the time, what the option market implies will happen is actually what happened. How volatile did the option market think stocks would be versus how volatile they actually were. So you're talking about the implied versus historical, right? What the market thinks is gonna versus what actually happened. And you take a look at those and you watch for breaks, right? You watch for where the options market is, putting a premium on the potential volatility, meaning the implied volatility is much higher than the actual volatility of the market. Or you look where the option market is predicting lower than what the actual market is doing. And you would say, well, options are a little cheaper than actually what happened. And so that's what you're talking about here. So I'm phrasing it that way because not everybody always thinks about historical versus implied volatility, but that's what we're talking about. Projected versus actually what happens.
Yeah. I mean, what we've seen recently is the implied is still, it's still more than the actual. And this is a little bit of a rolling, average, I think is the way they're doing it. Right. So, but I don't know. I mean, do you think VIX should have gotten higher? I mean, was the implied right? VIX is sort of a proxy for the implied. The implied is actually on each of the individual underlyings or the indices.
No, I think the VIX has been, you could argue, so let's give the number, right? You just talked about the VIX being in the 20s, right? Where did we close today? 23. And you're even just looking at a 10-day vol on this, right? Or is that you using a VIX number? Using a VIX number, right? At 23. But the historical volatility has only been 16. So when people are like, oh, the market's been crazy. No, it hasn't. You've had a 16 historical volatility, right? Mm-hmm. We just talked about long bars, but it's the close to close that matters. And the market really hasn't been that crazy. Like you have a 15 historic volatility, right? You're like below average actual volatility. Now, it feels bad because it's been mostly down days, but they haven't been, bigger than what was implied in the market. And they, when you look at that 30-day volatility, it hasn't been much. I mean, it's higher than average.
Jay, we look at
higher than average. It feels higher right now, but it hasn't been crazy.
No, especially on a close to close basis. Jay, we run a quant strategy called the Four Seasons. And a little inside baseball, we look at the volatility surface, and that's fancy for saying, oh, what's the 10-day implied volatility on like SPY, the at the money options versus 30 versus 90 versus different. Like when you see the shorter end in days of implied volatility rise above the further end, like that actually can be a bullish indicator, Jay.
Well, what it tells you is that the near term, right? The near term implied move, right, is more than the longer term, right? And so look, this is not 100% of the time true, but as volatility comes down, it's usually a factor of the market going up, right? People call volatility the fear factor. I like to call it the speculative factor. And so as the market is going up, vol usually comes down, right? The implied volatility usually comes down. People are expecting calm, less emotion. So what you look for here in the Four Seasons, this one indicator you're talking about is, hey, is the near term, I'm going to say fear or implied volatility, higher than, say, a longer term volatility, right? So the 10 days out movement versus, say, a month, right? Will things calm down? And so when that happens, when you see a disconnect between the near term volatility expectation and a longer term one, when there is a significant premium in the near term, it tells you, we're probably reaching peak fear. There's a term we use in the industry called capitulation, right? So it's like almost like, oh my gosh, I give up. The sellers are exhausted. They've given up. They sold everything they can. And that's when the buyers come in and the market kind of capitulates and consolidates at a low. That happens usually on fear. I thought we started to feel a little bit of that today, Derek, as we were kind of dropping down to that 56, 60 range on the S&P, the lows of the day. You and I started talking about, okay, is there time? Do we have to start doing any trades here? What are the rules that are going to start kicking in? Again, we're rules based on a lot of our strategies, but you still want to be able to anticipate when one is coming up. So I don't know. Did today feel like it was capitulation? I don't really think so, but I think we were getting there.
I'll let you know Monday.
Let me know Monday if the market's down a lot, then we'll know if that was true or not true. It was a nice rebound during today, right? But didn't feel like we had the washout sell-off that you're usually looking for in a lot of these rebounds. So who knows? Like you said, I don't know if that was the bottom or not. But my point is near-term volatility, right? That short-term fear, you look for that to kind of spike compared to 30 or even a 90-day volatility going out farther.
I mean, I feel like today it got close, but for me, one of the quick ways to tell, okay, have we hit a near-term bottom is let's see a nice open Monday. And by nice open, meaning maybe a gap up, and to hold that gap and to actually rally into the close. Like that would be a very good move, because we've seen a gap up, but then it fades the move. It just winds up closing.
Yeah, every gap up has definitely been sold to close the gap, even the same day.
Instead of buy the dips, it's sell the rips. We're in one of those modes right now. So, all right, let's talk about maybe one of the contributing factors, and that is the Federal Reserve Bank of Atlanta. They have a GDP Now forecast. It's a nowcast. And so we are still getting like the final numbers from Q4. But what the Atlanta Fed GDP does, it looks at every bit of data that comes in and it tries to predict based upon the inputs and everything that's coming in, what the Q1 will be before Q1 is closed. Caused a little bit of a stir because the GDP Now went from, I don't know, probably around plus 2% and change, maybe 2.5%. First quarter annualized growth, real GDP growth. At last count, it was minus 2.4. And remember, when you see negative GDPs, the old, back of the envelope was you get 2 quarters in a row negative GDP, that's a recession. So what caused this? It's the exports. So in GDP, you have goods, you have services, you have fixed investment, government, you have consumers, and net exports, meaning imports minus exports minus imports. And if you import more stuff than you export, it's a negative towards GDP. Jay, the recent number that came out, U.S. trade balance of goods and services was negative 128.8 billion. And our listeners can't see the chart, but the last time it was it was minus 100 billion back in, was that March of 2022? This kind of went down. Bloomberg had an article and they said the reason why the balance of trade is a lot of companies were front running the tariffs and they were bringing stuff in to avoid the tariffs. So whether it's from China, Canada, Mexico, wherever. So since this is part of the inputs, okay, I guess the question is this anything, or is this they front ran everything in Q4? And so now naturally we're, although this is, trying to input, no, this is this quarter. So maybe everybody just front loaded stuff before Trump put the tariffs in. I don't know.
I mean, that's what it feels like to me when I look at the import number. I mean, it's pretty dramatic how bad that net imports pulls down GDP. However, there's plenty of other things in here that are, slowing down a little bit, right? Like, is that
goods?
What's that?
Goods are slowing down.
Right? That's kind of a big deal to see that drop. What's the red one? Is that PCE?
That's PCE goods. Yep.
Yeah, so PCE goods.
Yeah. Services is still okay. So that's
it's positive, right? Services are positive, but less, but also less. So look, it looks like even without this net exports drop, you would be seeing a trend down. And look, my 2 cents on the nowcast is always it'll tell you the trend. It won't get the number right? Because it takes a while to actually get the number. But this trend is fairly negative.
It is, and there's more data that will come in. And you've always said, and I agree, the closer this gets to the actual end of the quarter and the release, because there's data that comes in after the quarter, for the quarter.
Sure.
And so the way this works is you'll continue to get updates from Atlanta Fed all the way up to the release of Q1, which will be, January, February, March. That will be at the end of April. You'll get the first estimate of Q1. So they'll be updating this all the way through, and it will get more and more accurate. But it still doesn't nail the number for sure.
Nope.
So,
yeah.
I don't know. I mean, this caused a stir.
It caused a stir, right? It caused a pretty big market sell-off the other day. It started this. It's like it's the second thing, right? You know me, there's always 3 things before you bottom out. We've got the tariff discussion. You got this GDP thing, which there's some overlap there. I don't know what the third thing will be, but after the third, maybe we get the capitulation.
1.44 positive would be the GDP growth if you took out the exports, if you evened up the exports.
So still positive.
And, Well, we, because of the natural gas, you go back to Russia, Ukraine, and natural gas, we've had a ballast in sort of the boat, or wind at the sails, whatever the heck you want to call it, because we've been exporting a lot of energy. We're a net exporter, or we have been for the past whatever number of years. I think we still are. I don't know that for sure, but that's helped. So, we'll see about this. All right, let's talk about the jobs data. 4.1% unemployment rate. I think you said, to use a golf term, Jay, kind of hit it straight down the middle. Like, it was a 240-yard drive.
Middle
down
of the fairway.
What else do you want?
Yeah. Yeah, I mean, look, 100, what was the final number? 150, 155, right? Was the, and then fine, expectations were a little higher than that, but unemployment rate ticked up a tenth. That probably has more to do with the labor force drop, which was fairly significant. Right, so the denominator moved, so the unemployment rate, ticked up a little bit. Wages were flat. Like, I don't know, there was nothing in this report that was like red flag for me at all.
No, the size of the civilian labor force dropped. So the way that you get the unemployment rate is you're taking the number of unemployed into the civilian labor force size. So because that dropped, it's a numerator denominator thing there. And we've actually been talking about too is with some of the changes, and let's say the ability to come to the US, in theory, you're not adding as many people to the workforce. So I sort of expected a drop in the civilian labor force, but I would agree, Jay, there's really nothing here that upsets anybody or gives anybody, any ammunition to say, one way or another. It's just, it is what it is, right?
Yeah, I think this was fine. It shouldn't have caused any damage. So, it's we always try to interpret this. Sometimes the market is slow to interpret this data point, right? There's a couple other factors that all kind of come in. And out of the gate, the futures popped higher. And then we ended up, so at 8:30, an hour before the market opened, the futures popped higher. And then by the time we got to the open, we were already negative, right? So they had already kind of sold off. And then it became more of the tariff story again, right? So it's the market has had negative reaction to the tariff news. It's funny, Derek, I think the last time we did the podcast, we were talking about every time tariffs were implemented, not every time, but it showed when tariffs were implemented, what happened in the market the next, 60, 90 days after, and even a year after.
Sell-off, and then
it was a little sell-off, right? And it was a blip up. And if you look at today, if you look back, you were like, oh, tariffs, we talked about, retaliatory tariffs today, and the market finished up. Not because of that tariff conversation, but it's almost like sometimes you're trying to disconnect the news cycle with the way the market ends up reacting. Today, I said I thought it was Powell that pulled the market higher. The Fed helped the market today, but it doesn't matter. The tariff conversation is still going on, still very active. Yeah, I mean, there's this negative reaction all the time. I remember the last time that we went through this, and it was like you would always get this down volatility scare when tariffs were mentioned, and it turned out to be nothing in the next few weeks. Well, I'm not saying that'll happen this time, but just that's what we have to reference, right? The trade war reference was 2 terms ago.
All right, we need to dig very deep into the initial jobless claims in the District of Columbia. With Doge and everything. I'm not going to spend too much time in this, but this is a good lesson in statistics and what you're trying to, what story, what narrative you're sort of telling people. And it's true, the initial claims in DC, and really the way to do this, I didn't know how to do it, Jay, but you'd have to look at DC, probably Virginia, like the metro DC area.
But this is at least we know fairly certain you have a government connection if you're in the DC area.
I would think so. So a lot was made of this. If you look at a chart, initial jobless claims in the District of Columbia, it went from what is this? 600 to 800 a week, something like that. And it spiked up, although it came down this week, it spiked up to over 1,800. And when you do a percentage increase, it's pretty significant. You can say claims. But then what I did was, I did this from March. I did it a 1 year back. And there's definitely a big jump. And then I did the same chart, but I did, I think, a 5-year chart, Jay. And the claims this week are sort of, they're actually not, they're lower than the spike we had in, what is that?
23.
Is that March of 23?
Yeah, that was around the mini banking crisis, right?
That's right.
And we had the worry that the treasuries were going to default. Do you remember that nonsense?
Yeah, that's right. Yeah. And certainly less than, it was close to 8,000 in I'm trying to gauge what this is, probably September, October of 21.
Yeah, what happened in 21?
I don't remember. I don't remember if there's anything that sort of.
Besides, we're still dealing with the pandemic, right? And that time, I think we're dealing with the Omicron variant, but
maybe
Delta or Omicron. But I don't know why that would have job numbers.
Yeah,
But your point is, if you just zoom out. This spike in initial claims in the DC area is nothing. Yes, it's moved up, but it's not at some level that's eye-popping. It's actually still very, very low and muted.
What I also wonder, all right, the last point on this, and we'll move on because I don't really care about talking about this that much. It's just when you have one administration that leaves and a new one that comes in, I know people are showing the Zillow real estate report. Biden and Harris. Harris probably had a house. Okay. JD Vance. Well, JD Vance was in Congress, but you know what I mean? People come into the administration and they're going to work in DC. They need a house.
Yeah, they come in, they go out.
Aren't going to leave. Yeah. And then people left. So, this happens. New administration comes in.
So
They bring
let's
their people
talk
in.
about this for a minute, right?
Yeah.
Let's just talk about why haven't we seen all of that? We've heard about all the points about all the people that have resigned or they took the deal, right? They were offered a severance through October and they're going to leave. Why didn't that show up in all the data, Derek?
Well, if they had another job already, and a lot of these people, I'm going to be cynical for a second, they lobby or they're in government and then they leave, they go work for a company. That's sort of the regulatory capture. Or if they're giving, if they're like, oh, we'll still pay you for 6-7 months.
Yeah, they're going to get paid through October.
Yeah. So, we'll see in October.
So that's when we would see, right? If those people didn't land another job,
that's right.
They would either come out of the workforce or they would be searching for a job and be on the unemployment. They'd be in the numerator. But look, there's plenty of time for them to get, but they won't show up here, right? Because they're still getting paid. They're not showing up as unemployed here. Is that correct? Right. Or do they?
I believe that's the case.
Yeah.
I'll double check that.
Which is why we haven't seen this big spike in that, because giving people plenty of time will certainly, mute the impact of what it hits to the unemployment rate. I think there's also, an immigration piece here to these numbers, like you said, right?
Yes.
Harder to get in the country now. Maybe people that don't have their documentation all in a row aren't going and looking for jobs, right? So how does that all impact the job market? There's a lot of factors that are impacting this report. There's a lot of noise in here. So it's great, again, that this was down the middle of the fairway today.
Yep. All right, Jay, I want to end with, we had some listener emails. One, it was just titled Sad. I'll read that. And
Okay.
But I think it's
sad.
An interesting one. It says, I've been listening to the podcast for a few years now. Thank you very much. But with the current regime that have taken over in Washington, I have to stop listening to your podcast. I have to cut back on using American goods and services and vote with my wallet. And also not letting companies get clicks, listenings, and views. Hope to return when there's a more sane government in office. If you get to vote again, that is ... In the meantime, good luck and keep hedging. Sincerely, a avid listener from Norway. Well, we're sorry to see you go, but we'll be here when you're ready to come back. Luckily, we don't take advertising on this.
I was going to say vote with your wallet. I don't think I'm getting paid today.
I don't know if we've ever talked about this. We've had offers for sponsorships. We've had offers for advertising. There was a golf club handle company that offered to sponsor us. And I was like, it was probably, an advertising rep. Was it the Magique? I don't know if it was Magique.
That was a little personal joke. So, yeah. Well, look, I guess we lost a listener from the Washington regime. The current Washington regime. It's cost us a listener.
Yeah. I'm going to write a letter. Yeah.
I'm sure he'll be able to vote again. I'm sure that'll happen.
Hopefully he'll be back though.
Yeah.
Hopefully he misses us and comes back. We do have listeners in Norway.
That's great.
Another one, Andres has emailed us before. He said, good morning. Hopefully I caught you before the pod. Yes, you did. My question is there minimum price on a stock? Like if a stock has 100 billion market cap, but is crashing by owning building land, hardware, can a stock go to zero? I think, and he says, thank you for being awesome and teaching us. Thank you, Andres. I think really the question gets into, like, if the intrinsic value of the business is still there, like stocks can trade above the intrinsic value, below the intrinsic value. Jay, I think though, if a company had assets that had value, if it went to zero, it would create an arbitrage opportunity. So normally there's some efficiency in here, right? I mean, it's...
Yeah, like if a company, like it's an asset, it's a hard asset, it's assets on the books, right? Mm-hmm. I mean, there's some industries you hear about the book value, right? In this case, if we're talking about a building or hardware or whatever, it's an asset that will have value. The company, that's included in the value of the company. And so if the market was to put a stock all the way down to zero, but yet they outright owned the building, right, that you think they could sell it for, that's value to the company. And if the company, even if the company was liquidating all its assets, or somebody came in and said, I'm going to buy, your assets on 10 cents on the dollar, there's still value that's that's involved in the company. And you're going to buy that company. Like at zero, stock at zero that owns buildings and hardware and machinery, probably shouldn't be at zero.
Yeah. It's the, remember back in the 80s, well, this is Wall Street, the movie. Remember Blue Star Airlines? They bought it and it was overfunded pensions and they figured they could break it up and it was worth more broken up and selling off the pieces than
It's a
even
good one.
Kodak.
If you haven't watched Wall Street, you should watch Wall Street.
Yeah. But no, I mean, it's companies can, here's the other thing I would say. Sometimes companies trade at a forward PE that's really high. And other times you're like, oh man, it's only trading at 4 or 5 times earnings. Doesn't mean it can't go to 3 times earnings, but it gets to that valuation piece too. And so, yeah, I mean, stocks can go bankrupt. And, but if they have assets and they have, their debt situation, normally that would be an arbitrage opportunity. So
that's the hard thing. Like, it's one of the factors about picking stocks, right? That's difficult. Stocks, we always talk about the market on average. The market was just at an all-time high. The market always continues to hit, has in the past always hit all-time highs, right? The market has always grown. But that's not the case for individual stocks. Not every stock will grow, right?
Yeah.
You take that idiosyncratic risk, single stock risk when you own a stock. And there's plenty of I can think of 4 or 5 stocks I've owned that did go bankrupt and got, but I would have rather owned the index. Now, the flip side also occurs, right? If you want to try to have outside gains, you want to get heavy on a Palantir, right? And you're like, by the way, that's another PE ratio that we could probably do a whole show about.
Yeah,
I'm going to quasi start you on that if you want to. But, you could say, look, I want to buy the big winner of the year. You have this upside that'll definitely outperform the indexes, right? If you get the right stock. But an index is it's just sometimes easier, right? If you're not going to spend all day doing research or you're in a I'll call segment or industry where you have an expertise and you just know, right? Like, let's say you work in InfoSec and you say, look, I just happen to know, I'm making this up, right? Palo Alto Networks is gonna outperform CrowdStrike because they're getting better contracts, and I see their product, it's better, right? Fine. Then you could make an investment. I used to call it exercise your inner guru. But, putting all your eggs in one of those baskets, you could find a stock that goes to zero. It happens fairly regularly. We should probably get a data point on that. But stocks go to zero. Individual stocks go to zero. Indexes, keep safe. It's almost like the cheat code, right? It's fine. You want to take some risk on individual stocks. Great. But the cheat code is invest in the indexes. I mean, it's what Warren Buffett will tell you, right? Not that I'm saying he knows all, but I guess he's considered to be a pretty smart guy. He'd say buy an index fund, right? Until you get to that point where you need specials, buckets in your portfolio, avoid the zero potential stocks. So sorry, Andres, I got off on a little tangent here, but you're right. Stocks can go down. They can have assets. They can, have a value because they have hard assets. But why even, most people don't need to endure that with the majority of their money. Buy an index.
All right. We like emails. Send those to me, derek.moore@zegainvestments.com. That's derek.moore @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to figure out how to spell if you want to email me. All right, Jay, recommendations this week. What do you got?
Okay. So I started a recommendation the last time I was on when I talked about the show Paradise on Hulu. I have a strong conviction reinforced by you should watch Paradise. There have been some very intense and moving episodes. Did you pick that one up yet, Derek?
No, it's on my list.
Pick it up.
No, you told me about it. Yeah.
Pick it up. Strong buy on Paradise. I'm also watching, Reacher on Prime. It's the 3rd season. I enjoyed the first 2. I'm enjoying this one. I actually think it's better than the 2nd season. So pretty good there too. That's really it.
Okay. I watched it was on, and I hated watching it with commercials, and they bleeped out everything, but The Departed randomly. What a good movie that is.
What a great movie.
Yeah. And I looked, it wasn't streaming anywhere. I'm like, I just got to switch over to the streamer. It wasn't streaming anywhere. So
there's a lot of bleeping on that movie then.
Might be. For me, so Drive to Survive comes out. Yeah, I mean, we're recording this on a Friday. It comes out today. So if you haven't watched Drive to Survive, that follows the ins and outs of F1. F1 racing, and this is the 7th season now, and they're doing it. I think next week is the Australian Grand Prix, I should say, to say it correctly. So that's my thing, Jay.
So that's on Netflix, right?
Netflix, correct?
Yeah. I enjoyed that. I watched the first couple seasons of that. I don't know how it fell off my list, but that's a good one for sure.
Yeah, I think that's it, Jay. All right, well, go up market, do your thing.
Right. We'll see on Monday how it does.
Yeah, I'll let you know. Next week when I talk to everyone. All right, see everyone. Thanks, Jay, for coming on.
Thanks for having me back, Derek. Bye.
See ya.